Hopefully everybody's hanging tight with this market. I know it's shaking a lot of people up, but reality is it really is just a news-driven blip on this chart. Everybody kind of overreacting. Maybe it puts the top in the market, but overall, I think the market's just having a reset. Keep in mind, some of the biggest and sharpest pullbacks in a market happen during a bull market, during a rising tide, and the sharpest rebounds typically happen during bear markets. So overall, definitely a piece of news hit the market. It's a very sharp pullback, shaking things up. In the grand scheme of things, the SP500, if we look at our 30-minute chart, it actually is just in oversold territory. Obviously got driven down. We had a huge panic wave of a ratio of 9 on the close of that previous session, telling us that, hey, this could be a standout low. There's definitely people running for the fences, people dumping everything. And I think all the momentum traders in the Magnificent Seven and all the fast-moving stocks very quickly just jumped ship and bailed out. And we'll see how this market shakes out and if it's going to rebound from here. But today, the market is starting to recover. If we look at the 10-minute chart, just in the last 10 minutes, we're starting to see the SP500, the markets start to pop up. Let's take a look at the QQQ in pre-market. We're seeing the stock market starting to come back a little bit. They were trading lower overnight. We'll see how things kind of unfold. But let's just jump over at the main strategy here. If we look at CGS, the strategy here, we still have the SP500 holding up. Now it's a pullback. It's to the 50-day. We've had pullbacks like this before. This obviously is a very sharp pullback. Just shows how sensitive the market really is. We hit all-time highs about a week and a half ago. And it's pulled back into a support level with news. If we look at the QQQ, it came up. We hit that 10% target with our CGS strategy, and it popped a little bit higher, and then we had news and we got hit. And this isn't a trend exit. This is a protective stop exit, saying, hey, if price is pulling back too sharply, let's get out. So overall, NASDAQ is flat. And we're not in the NASDAQ with the band strategy or the CGS anymore. But the overall trend still remains up. When we look at the SP500, we are still in this rising tide environment. And if we actually look here, we had the markets, this bottom chart down here, this is the 60/40 portfolio, the Vanguard 60/40 portfolio. And if you look at this line I drew on here, we're right back to more or less back to 2021. We're back to break even. The average buy and hold portfolio just underperforming. It hasn't really gone anywhere other than down and gave everybody a heart attack. Whereas the stock market itself is up fairly dramatically, and of course, specifically our CGS strategy is up as well, moving higher. And it just goes to show the power of being diversified. And this is the good example of this. Really is just knowing which asset to be in. We have money moving into equities, which we got in, and we've been taking profits, and money's been flowing, out of the other asset classes like bonds, and it is down dramatically. One's up, one's down, and that's why you get this neutral. If both go up and down the same amount, up 10%, down 10%, you end up with this neutral flat return, which is this. We're right back to where we are from several years ago. And that's a lot of wasted time, which we don't really get back. We can always make money back, but we can't make time back. And that's the whole point of our strategy. So anyway, let's jump into where the money's flowing today. So it has been moving out of stocks overnight, but it's starting to rotate back in a little bit. Just starting to hook up here in the last hour or 10 minutes, depending on the index. We are seeing bonds move up. They did take a big haircut yesterday. They dropped 1.5%. We saw TLT drop down. And I think we did see rates go down, which usually means bonds go up. But the long-range forecast from the Fed saying, hey, we're not actually dropping rates really at all over the next year. And I think a lot of people were positioned in bonds expecting rates to crash and fall. And now they're like, well, if the rates aren't going to fall, I'm getting out of bonds. It's going to be a dead play for a year. So that's what we saw, was a lot of people just saying, get me out of bonds, I give up. Which probably means we're actually going to, probably see them start to rally and have a bounce because everybody just got out. That's the way the market works. I do think eventually we're going to see bonds rise and do very well. The Fed's saying their inflation's here. I think they're saying that rates aren't going to go down much. But I think when push comes to shove, when the economy goes into a landslide and businesses dry up and go bankrupt and layoffs kick in, the Fed will eventually start cutting and bonds will take off. But there's going to be a lot of blood in the streets. People need to close their wallets and everyone stops traveling. They stop spending on everything. And then eventually inflation will drop. But there'll be a lot of businesses going under to reset pricing and inventory costs and all kinds of stuff. It really is just the cycle. Unfortunately, a lot of people are going to get hurt, and they have to get hurt for the reset to actually take place. So that's kind of what I think will happen in the long run. Anyways, let's take a look over at the put-call ratio. Put-call ratio moved up near 1 yesterday, telling us that, hey, there's people are starting to buy some downside protection. I think yesterday, it'd be interesting to see where the put-call ratio is today. I think people are super bearish now. And I think we might see a lot of people buy put options. If it's over one or over, that means more people are buying put options, betting on falling prices. If the put call ratio, is the way I see it, is over 1 and everybody's buying, the majority of people are buying put options, that means they've already sold their stocks, their ETFs, and now they're buying leverage on the downside. And if everybody's already sold their stocks, then there really isn't much selling left and the market's going to bounce, and they're buying, and usually the masses are on the wrong side and they always use leverage at the wrong time. So they've sold their positions. Now they're going to bet on falling prices with leveraged options, and then the market's going to rebound and they're going to take a beating. That's typically how it works. Not every time, but that's the majority of how that plays out. If we take a look at the VIX is down a little bit, but again, we've got a big spike in the VIX. This is one of the largest spikes we've seen in a long time. And it's telling us that there's a lot of fear in the market. People just dumped shares. But it's interesting because when we look forward on different contracts for the VIX, really it's just this month. The short-term curve for the VIX is just a quick spike. It's not looking like the volatility is going to extend out several months. So this, I think, is just a fear-driven spike. And when the VIX is high, it's time to buy, meaning when the VIX is high and everybody's panic and selling everything and they're all running for the fences, that's when you want to buy. That's a dip, a pullback. So I still think the stock market is going to recover. I think we're going to see it want to grind higher and up into the end of the year. For some reason, people think that one-day sell-off changes everything, which really it's way overweighted because it's a news-driven move. It's a one-day pullback. Just because it's big doesn't mean it's a game changer in terms of everything yet. So that's kind of where I kind of stand on that point of view. If we take a look at the dollar's pulling back a bit this morning because it's had a very nice run. I am bullish on the dollar. Dollar's down and we're seeing gold up a bit. So we've seen gold pull back with some fear, and this is what I focus on trying to let everybody know is when there is selling in the financial system, when we're in a bear market and there's global panic, almost everything goes down. Gold is not a safe haven play. And of course, we've seen that. Gold has moved down with the fear, had a big move down on the news. So don't think of it as going to be a safe haven play. Again, gold has been trading sideways. It rallies, it pauses, it rallies. It's in a pause. We've been talking about it could have this huge sideways range and just it could continue to chop through here. It might want to, I think it's going to want to drift and grind higher into the end of January. I don't think it's going to be like super high. I think it's just expected to be in this big noisy range. It's kind of a dead trade at this point. But everybody seems to be very glued to gold, expecting it to go a lot higher. But the move is done. We hit our target and we've had the market change. We had a piece of news hit. It's amazing how when we use Fibonacci levels and we have these targets get hit and then something happens in the market, like we have the presidential election and we have all these different things like the NASDAQ hit our 10% target. And then of course we have a big piece of news and there's a big reset. We see this all the time and people are always thinking that you can't predict that there's going to be a shakeup. But when these measured moves are triggered, they are all triggered. All these moves that we have are for a reason. It's when momentum's going to stall. It's when there's going to be some type of change. We never know what it is, but when prices reach these certain levels, something happens. It's just the way the universe works, and we don't know what it is, and we just kind of have to just understand. That's why we need to move, protect our positions and things like that. If we look at Bitcoin Bitcoin was the exact same. We hit our first target a couple days after getting in, and then it had a quick pause. We hit the next target, which if we were to zoom in right up here, we hit our target on Bitcoin. We closed it out right here, and it's fallen back about 10% from the high to the low in the last few sessions. And that was a Fibonacci target on a monthly or weekly chart going way back, telling us that these are critical levels. The first level, if it has a lot of momentum, it's going to run up to the second level, the 100% measured move, which is up here. And then we're probably going to see something happen, and that's what we've seen. Again, we don't know what the news is going to be or what the cause is. It doesn't matter because no one can predict it. All we need to know is follow the charts, follow the momentum, and when you hit these key pivot points, make sure you take action of trimming profits, moving stops up, all of that stuff, because most likely something is going to happen. Momentum's going to stall, whether it happens with news or no news. That's just when the stock market or the energy behind that asset class is going to run out of steam, and there's going to be some type of little change in things. All right, let's take a look. What else do we want to look at? Let's look at crude. It is down about 0.7%, pulling back a bit. Crude oil, just hanging on to a thread. I think it's just a matter of time. One little piece of bad economic data, we are going to see it fall and collapse, and we're going to see energy stocks probably get hit even harder, which energy stocks are down fairly sharply. In fact, I think here's kind of an energy shot. The top one is XLE. It's been moving up. Energy oil has been moving down. It's at a major support. We've already seen the energy sector pull back 14%, which is nothing compared to what I think is going to happen when we get a bad piece of economic data. Oil breaks down. Trump gets in. They start drilling everywhere in North America. Recession kicks in. Energy stocks are going to get hammered down 40, 50, 60% most likely. So this will be very interesting to watch. Huge divergence, moving in opposite directions. Something's going to give. I feel like it's going to give to the downside unless nukes start flying and World War III starts. Oil will skyrocket and energy stocks will skyrocket. But we can't bet and worry about black swan events because most of the time they never happen. And if they do happen, if you're on the wrong side of the trade, you just switch positions or close it out. When we take a look at the hot list, let's look at some of the ARK ETFs here. They've had some selling going on, some high volume selling, which is normal. Pretty much everything had moved down on that session. One of the big ones that really got hit was real estate. And of course, look at that drop in real estate, massive volume. People look at the REITs sometimes as like a good, safe investment because it's real estate. People all own their own home or home properties. They feel comfortable with it. But REITs aren't quite the same. For a house value to drop like 12% usually takes a long time. And a REIT moves more so with people's expectations and fear. It's not really driven with the value of the properties. It's just a stock. It's like it can be way undervalued or way overvalued. I think REITs are a great way when we get into a new recession and all this resets. If you want to get into real estate in a very kind of lucrative way, REITs are great. You can move into self-storage ones. You can move into this one. They pay great dividends, especially when they get cut in half after the next recession. The dividends will be really juicy and allows you to put in like $100 if you wanted to buy into some self-storage or put in $100,000. You don't have to buy a whole facility and you can cash out in the blink of an eye. But overall, we're seeing, obviously, if rates are going to stay higher for a while, people are worried just high rates mean it's going to be expensive on real estate. Real estate is not going to be really going up in value. And so people are getting out of real estate because the Fed's expecting to not drop rates much. And we're seeing mortgage rates continue to hold up or move higher. In fact, so that is one of the reasons we're seeing this unwind as a play here. Anyways, I think that's about it for this morning. We'll see how things unfold from there and just kind of take it one bar at a time. Talk to you soon. Bye-bye.